Good evening, everyone, and thank you for joining us. Welcome to Ironwood Wealth Management's Market Insight webinar for the third quarter of 2014. My name is Nicholas Basso, and I'm a Portfolio Administrator in Ironwood's Investment Division. Tonight, it is my pleasure to introduce our featured presenter, the Chief Investment Officer here at Ironwood, Mr. Steen Rogers. Steen is a charter holder of the Financial Analyst designation, and he also serves as Ironwood's primary investment strategist. If anyone has questions for Steen during the presentation, please feel free to type them into the questions box on the GoToWebinar panel on the right side of your screen. We will do our best to address all of the questions at the end of the presentation. And now, without further delay, please join me in welcoming Steen to lead this evening's presentation. Steen?
Thanks, Nick, and welcome everybody to our quarterly insight call. Tonight we'll go through the first half of 2014. Fairly quiet first half of the year until just recently, so we'll talk about that. And we'll try and put some clarity on the remaining portion of 2014. We know the last few days obviously have been a little bit more volatile than the first half of the year, but we wanted to make sure that everybody knows a 3% move in a few days is normally par for the course. And we've been a little spoiled lately with low volatility for actually an extended period of time, and we'll discuss that further in the presentation as well. Like always, we'll go over returns for the previous quarter, which was quarter number 2, and then we'll go through what we see as implications for the rest of 2014 and how we've changed the portfolio and what our thoughts are as far as investment implications and what does it mean to our portfolios. So I like to start with kind of where we are in relation when we look at the S&P 500 in relation to recent history. You can see by this chart that it looks like we're at a new peak, and if we kind of follow this chart here, it's up and then down and then up and then down and now up, and we're waiting for the down. And that doesn't always happen, and I'll get to the next chart here in a second. But before I do that, I want to show that each of these peaks is a little bit different. In 2000, we had a P/E multiple of over 25. Price-to-earnings ratio is just a valuation metric. The higher, the more overvalued we possibly are, the more somebody's willing to pay for an income stream versus a lower price-to-earnings ratio. The dividend yield was at 1.1% back in March 24th, 2000. So we weren't getting paid a lot to hold the S&P 500. And the corresponding 10-year Treasury was at 6.2%. So March 2000, if we were an investor, we could have bought the S&P for $15.27 on that day and paid 25.6 times forward-looking earnings, 25.6 times earnings at $15.27. We could have sat there and earned a 1.1% dividend yield, or we could have invested in the 10-year Treasury at 6.2%. But March 2000, when we hit that all-time high back then, markets were going up 30%, 40% per year for 3 years in a row. And so 6.2% in a 10-year Treasury didn't really seem all that appealing back in March 2000. Now, fast forward to June 2014, if we could find a 6.2% 10-year Treasury, it'd be very appealing right now in this environment. So each of these, I bring this up just to show the differences. And even if we look 7 years ago, back October 2007, when we reached 1565, the P/E multiple wasn't stretched. 15.2, we're at 15.6 now. That's well in line. That's about average. Not overweight, not underweight. It's pretty, historically speaking, right along par with fairly valued, what people will usually pay for the S&P 500 earnings. The dividend yield, 1.8%. You know, that's typically where the dividend yield has sat for a lot of recent history. But the 10-year Treasury, 4.7 versus 2.5. So we're really in a unique situation here, and I just wanted to start with these metrics to kind of start with a starting point for today's discussion on kind of where we are in relation to tonight's topic or talk. And once again, this is only a 17-year period of time right here. If we really want to get the true picture, we've got to look at something that gives us a little bit longer period of time. And throughout history, we've had periods of time where the market on a price basis doesn't really go anywhere, and then it takes off, and then, you know, we have some hiccups, and it doesn't really go anywhere, and then we have some really good years, and then we don't go anywhere, and we have some really good years, and then we don't go anywhere. These are bull and bear cycles, and we believe that this most recent high that we hit on the S&P 500, we believe that we're in a new bull cycle that could last multiple years. That doesn't mean that we won't have some hiccups along the way that will be 10 or 15 or 20% declines in the S&P 500, but to see a long period of time where we get some pretty good returns from equities, that wouldn't surprise us. So what happened in quarter number 2? Quarter number 2, domestic equities did very well. The S&P 500 during the quarter was up 5.2%. Small caps lagged. Most indexes, most equity indexes, I should say, they were only up 2% for the quarter. International, developed, was up 4.3% versus emerging markets was up 6.7%. So you can see the tilt toward emerging markets paid off during the second quarter. Something that continued to surprise us was the 10-year bond went from 2.72% down to 2.53%, and as of this afternoon, we're at about 2.48%. We'll talk more about that when we talk about the Fed and when we talk about interest rates. Economic data has come in very positive, especially recently. The ISM numbers have been very good. Early in the year, we had some disruption. A lot of that was due to weather. A lot of that was due to inventory. We had a GDP number that was first printed at negative 2.9%. That's since been revised to negative 2.1%. And the second quarter, the first estimate is for 4% growth in GDP. So we'll talk a little bit more about that, but 4% is a very strong number for GDP. And it shows an increasing economic recovery here in the most recent more recently. The ISM number for non-manufacturing, you can see I've got some numbers here, but just this morning the non-manufacturing number came out, and it was 58.7, which, just to give you a little bit of context, was the highest number we've seen since late 2005. So that was a very strong number this morning. Friday we had jobs. They were very positive. During the quarter, we actually had a June jobs report of unemployment rate of 6.1%. Friday, that bumped up a little bit to 6.2%, even though we created over 200,000 new jobs in July. The unemployment rate is very choppy, and even though the trend is very positive, to go up 0.1% while we're in a major trend of decreasing is not a big deal. A lot of folks who were despondent and were answering some of those questions, I'm not looking for work. Now they've changed their tune a little bit, and maybe when they get that phone call from the Labor Department, they're saying, yeah, I actually am looking for work, and so labor force has actually increased, and that was partly why that 6.1 bumped up to 6.2. But the overall projection is still an improving unemployment number and improving employment numbers. So that was the second quarter. Very, very good, strong quarter. The first estimate for GDP once again is 4%. That is a very strong number, and it a lot in part has to do with we were kind of making up for that first quarter slowness, some inventory and weather problems that we kind of made up for. But so far in the first half of the year, REITs have been the strong performer at just over 16% for domestic REITs. The S&P is up 7%. Now these are as of June 30th. So a lot has happened in July. So these numbers are a little bit, they're 30 days old, and stocks have come down since then a little bit. But this is where we were at the midpoint of the year. Commodities were up 7.1, emerging markets up 6.3 for the year, developed international at 5.1, bonds up 4%. Once again, that's a great return from bonds, a lot due to interest rates going from above 3% down to below 2.5% during that period of time. Small caps lagging. That's something we want to keep an eye on. You know, when equities are doing good and small caps lagging, that doesn't happen often. It's a divergence, and we want to make sure that we keep an eye on that. Cash 0, market neutral, negative 1.2%. So all over the board, but for the most part, most asset classes have done well in the first half of 2014. We talked about this a little bit in the data from quarter 2, but the economy continues to improve, especially the U.S. economy. Quarter over quarter, the first estimate was that negative 2.9% number. That's since been revised to negative 2.1. And the first estimate for quarter 2, like I said, was 4%. So in context, if we put that into a little bit of context here, the expansion average has been 2.1%. If we look over the past year, our year-over-year GDP growth, even with the negative 2.1% first quarter of this year, we're still looking at 2.4% GDP growth year over year, which is it's not great, it's not horrible, it's a little bit better than the expansion, and it's a little bit less than the average since 1965. Now, there's a lot that's changed since 1965. Post-World War II, a lot has changed, and that speed limit has gone from an average of maybe 3% to more realistic average of about 2.5% because some of the population growth that has changed since the World War. So to have 2.4% year over year, that's well within where we've been over the last 20 years. If we were to average the last 20 years versus the last 50 years, we'd be right around 2.5%. So 2.4% is right there. Some of the economic factors that's really been helping the United States economy, auto sales have been phenomenal. You can see 16.9 million units in June. Housing starts have continued their positive trend. Interest rates have come down again, so that's good for housing. Inventories, although we had a little bit of a bounce in the first quarter, and you can actually see it even on this chart. You see the spike here in the first quarter, but we've used those, and we'll continue to build those up. But inventory levels are pretty tight, so if there's more demand, we're going to have to create things. And then real capital goods orders have been very positive. CapEx has been very positive. On top of that, companies that have been spending on CapEx have been showing better revenue growth than companies who haven't been spending as much on CapEx. So there's a lot of positive in the economy, and that's a very positive thing when you're seeing new highs on the S&P 500 there's got to be a reason that we're getting to those highs. It can't just continue to be PE multiple expansion. We want some meat behind the numbers, and we've gotten some of that. Consumer finances have improved tremendously over the last 5 years. Just over the last 2 years, net worth for consumers has increased by $14+ trillion. That helps confidence. That helps consumer confidence. Household debt service is still at very low levels. That's that top right graph there. You can see still very low levels. Even though we had a little bit of spike up in interest rates at the end of last year, we've basically given back that increase, and we're sitting at about a 2.5% 10-year Treasury, which keeps housing very affordable. Total liabilities actually have come down 8% since 2009. So not only has our consumer balance sheet assets grown, but our liabilities have reduced by about 8%, and that's how we get this net worth number to have increased over the last few years. Consumer confidence is improving. This helps consumer spending. This helps PE multiples. Confidence is a very circular momentum-driven metric that we definitely want to keep track of. When folks are confident, they're going to spend more money, they're going to buy more things, they're going to invest more aggressively, and that really tends to help drive economic conditions. Employment, like I said before, in May we had 6.3%. Actually in June that dropped to 6.1%, and July that increased to 6.2%. We've had almost 10 million new jobs created, which outpaces the 9 million that we lost during the recession. The trend very positive. Inflation is one that I definitely have my eye on. Even the last 2 weeks, we've seen a few indications that inflation is starting to increase. I think the best place to look for this is wages and look at some of the employment reports, because when wages start to increase, that's going to have an impact on our CPI and on our inflation. Just because the Fed is printing money doesn't necessarily mean that inflation is going to spike, and we'll talk about velocity when we get to the Fed a little bit. But a lot of folks are kind of confused that inflation hasn't really gotten out of control because the Fed's balance sheet has grown so much. And we'll discuss why that is when I get to the Fed, which is coming up here in a couple of slides. Interest rates, the Fed, and QE, right on cue there. So interest rates have really confused a lot of economists, including myself. I'll be the first to tell you that at the end of 2013, interest rates were at 3%. They have been increasing. You can see here we were increasing. We thought those were going to continue to increase, 3.5%, 4% on the 10-year Treasury, and lo and behold, the first part of this year, interest rate, the 10-year Treasury went back down to 2.5%. It doesn't make a lot of sense to me. The economy is picking up. The Fed is telling us that they're going to be done with QE, but they still are buying a lot of bonds, and they're the biggest buyer of bonds that's out there. Not only are they continuing to buy with quantitative easing, but also when their securities are maturing, they're rolling those over and buying new securities with the maturing securities. So I think a good place to start is the Fed when we're talking about interest rates. And I know I've talked about this in the past, but there are some new folks here on the call, so I want to make sure that I spend a little bit of time. There's a lot of confusion in this area, so I don't think a little bit of time on this slide is a horrible thing to do. So the Fed's balance sheet here continues to increase, and it really has since the financial crisis. We saw an extreme amount of quantitative easing in late 2007, early 2008, and ever since the balance sheet has increased. This period right here, the end of 2012, early 2013, is when we did the quantitative easing into perpetuum, where they said they were going to do $85 billion a month of purchases of bonds to try and keep interest rates as low as they could. Now that $85 billion, as of the Fed meeting last week, has now decreased. So they're still increasing this balance sheet. They're still buying bonds. They're still creating money. So they're still printing money, buying bonds from banks, giving banks the cash, taking the bonds out of the system. So they're flushing the system with liquidity. The reason that we're really not seeing all that inflation happen is because the banks are putting that excess cash right back to the Fed as excess reserves, and you can see excess reserves have gone up almost in the same rate that the Fed balance sheet has gone up. So you have the Fed buying the bonds, giving banks cash, basically, and then you have the banks putting that cash back to the Fed and saying, you know, we're going to keep this with you because we don't want to do anything with it. We don't want to loan it out. And so that's the velocity of money, is what are banks doing with this money? Are they loaning it out and creating economic activity, or are they just saying, you know what, we don't want that money, we don't have any good uses for it, we're just going to keep it as excess reserves? And so it's like the Fed opens the top drawer of their desk, takes out a bunch of money, puts it into the bottom drawer of their desk, closes both drawers, nothing really happens, and we're pushing on a string. But there is a lot of liquidity out there, and if banks started to lend it out, that could definitely be a game changer. If the velocity of money picked up, we could see inflation jump up pretty quick. I don't think that's going to happen until we see some wage growth, the inflation picking up. But we're starting to see hints of that with an improved job market, so we want to keep an eye on that. So the Fed, getting back to my train of thought here, the Fed has decreased this increase by $60 billion. So we've gone from $85 billion billion dollars of purchases a month to now we're at $25 billion of purchases a month. It looks like they've got a September meeting, the middle of September, and then they've got a meeting at the end of October. And it looks like by the end of October, they'll be done with quantitative easing. So what that means is this balance sheet will continue just to flatline. It'll still stay up here near the $4.5 trillion mark. So we're not talking about decreasing it. We're not talking about the securities that are maturing. They're still talking about rolling those over. So we're still going to have an extraordinarily large balance sheet for the Fed. And they said in their minutes that they're going to keep interest rates low still for an extended period of time. There is a little infighting within the Fed. Plosser dissented with the minutes, and he believes that the economy is going at a faster pace, and he'd like to see some of the language in the Fed minutes changed. Fisher actually had been dissenting. There were some changes in the language that were in line of a more improved economic picture by the Fed, which makes me believe that folks at the Fed are getting more confident with how the economy is performing, and I think the risk is that the Fed does more than what the market thinks the Fed's going to do. And when I say it does more, I mean reduces monetary policy, tightens monetary policy quicker than the market thinks. If that happens, we believe that the bond market could be disrupted very similarly to how it was disrupted in the summer last year. So that definitely is one of the things that's on our radar when it comes to the Fed. We believe that the market is pricing in rate increases, near the end of 2015. We think that rate increases in the Fed funds rate could happen earlier in 2015, and if that does happen, it could lead to a bond market that's kind of self-fulfilling and kind of makes the Fed react faster than they may want to. So, and we have positioned the portfolio with that in mind. So that's what I really wanted to touch on here in regards to the Fed. Credit conditions. So I said banks aren't lending. This proves it right here. The average credit score on approved mortgages, you can see how much higher it is than it was in the 2000s, all the way even, 2003, 4, 5, 6, 7, 8. Not until 2009, when the financial crisis happened, did lending standards start to tighten up. And you can see even more recently, you've got to have a 740, or the average score is for approved mortgages 741. That's a pretty high score for an approved mortgage. You can see compared to the last, if you look at the last 5 or 6 years compared to the previous 10 years, you've got a substantially higher credit score. It's the average for approved loans. Delinquency rates on residential, consumer loans, and commercial and industrial loans has all come down. You can see the residential really spiked up during the financial crisis, and it's come down a lot, but it's still at elevated levels. And banks they're not eager to go out and lend if this is the case. And so that's probably why this 741 is what the average is. Mortgage originations, much lower, even though we're in a very advantageous environment for new mortgages. Housing prices haven't gone out of control, but mortgage rates are at historic lows. But you just don't see the originations like you did in the late 90s and 2000s. But that's, the housing market was one of the hardest hit markets during the financial crisis, so there's a lot of recovery that's happening in there, and you're just not seeing the originations like you once were, which is not necessarily a bad thing. Common equity as a percentage of total assets for all FDIC-insured institutions. This is the Great Depression, basically, to more currently. And you can see the level of common equity as a percentage of total assets is at levels that we really haven't seen since the Great Depression. So there's a lot of fear with banks and financial institutions, and they're playing it very cautious. And that is one of the reasons the velocity of money has not picked up. Banks just are not ready to take any more risk than they're ready to take at this point. Doesn't mean it can't change, but that's the situation that we're at now. High-yield bonds. High-yield bonds are a very interesting story. This page looks at the high-yield bond market. The top chart shows the spread between the yield of the JP Morgan Domestic High Yield Index and the yield on comparable maturity treasury bonds. So you can see that if we look at that, the difference between the JP Morgan Domestic High Yield Index and comparable yield treasury bonds, you can see that the spread most recently for high yield is 4%, versus the average over this period of time of 5.9%. So we're getting paid less to take similar risk than we were in the past. And you can see that same phenomenon with leveraged loan spreads. The latest was 3%, and the average is 4.9%. So those are significantly lower yield spreads than what we've seen in the past, which makes us very hesitant to want to be much in this space because we're not getting paid for the risk that we're taking. And you can see some of the risk is starting to rear its head here with default rates. They've spiked over the last few months. Definitely in 2014, you can see this spike here. That doesn't bode for a very good asset class in the near future. The bottom left chart shows historic recovery rates, so that's in line with history. The bottom right shows mutual fund and ETF flows into the high yield market. Like I said, we're a little concerned with the current spread numbers for both high yield and leveraged loans in comparison to their long-term average. It doesn't appear that we are being compensated for the risk we are taking in these asset classes. And because of that, today we actually made some portfolio changes. We got rid of a few bond funds. This is probably going to impact a lot of you that are on the call. So you'll be getting confirmations here, but we changed the bond portfolio today significantly. We're going to send out a little note to describe it a little bit more, but you'll be getting that here in the next couple of days once we get that together. But know that we are cognizant of this, and this is the reason why. We just don't believe that we're getting paid for the risk that we're taking in some of those spaces. So in the meantime, we want to hang out in something that's not really going to hurt us either way until we figure out where we want to adjust those allocations and still keep the portfolios in line with our risk budgets. Fixed income yields and returns, we've shown this chart before. This is just what's the impact of a 1% rise or fall in interest rates. So you can see if you have a 2-year treasury and interest rates increase by 1%, your portfolio will go down, your 2-year treasury will go down by about 2%. Versus if you have a 30-year treasury where you're locked in for 30 years on that rate, if interest rates the next day go up by 1%, well, your bond is going to be affected much more dramatically because you've got 30 years of cash flows fixed here versus 2 years of cash flows fixed here. So there's that opportunity cost over 30 years or over 2 years. A change in interest rates is going to change that opportunity cost of holding a 2-year treasury versus a 30-year treasury. So when interest rates increase, it's bad for bonds typically, and when they decrease, it's good for bonds typically. So you can see the differences between what would happen if we had a 1% increase in interest rates, which we believe is a more realistic scenario over the next year. So, we want to shorten our duration. We want bonds that are shorter in duration, meaning 5 and 2 and 5-year type bonds. Floating rate, if it was just looking at interest rate sensitivity, would be a good one to hold. But floating rate also comes with credit risk. So all bonds are not created equally, and they all react differently. They're all affected by interest rates. We want to know how that will be affected by interest rates, but we also want to know what the other risk factors are with each of these bonds. Right now, bonds are not our favorite asset class. Everyone on this call, if you've been on any calls, you should know that. We just don't believe we're getting paid for the risk that's in the bond market, with rates being this low, with credit spreads being this low. And so, we've definitely shortened our bond portfolio and actually reduced the credit risk more recently in that portfolio. And we're really sitting there waiting for yields to increase so that some of these areas will be more attractive and they'll be paying us for the risk that we'll be taking versus, in our opinion, not paying us to take that risk. Correlations between weekly stock returns and interest rate movements. This basically just says when interest rates are low and increasing, we have a positive relationship between yield movements and stocks. So in a simpler way, as interest rates go from 2.5, where we are now, to 5, history would show, and this graph would tell us, to expect a positive relationship with the stock market. So as interest rates go to 5% from 2.5, not to say that they are automatically going to do that, but if they were, that would, looking at this chart, would be a positive thing for stock, meaning stocks typically would go have a positive relationship, so they'd also increase until yields get to about 5%. Once yields get to 5%, you can see then we start to have a negative correlation with stock movements. So once we go from 5% 10-year Treasury to a 6% 10-year Treasury, that's usually negative for stocks, meaning stocks move in the opposite direction. So these orange dots here are the last 12 months. You can see an increase in rates has been positive. There's been a positive relationship between that and stock returns, even over the last 12 months. And there's a pretty good correlation here, or fitting with this correlation matrix here. So we believe that the economy is getting better, whole scale. Folks are starting to price in the Fed moving maybe a little bit faster than what the overall market is expecting. We think long run that's very positive for stocks, and we think long run that's going to be meaning that interest rates are going to increase. So we'll see this slowly increasing interest rates along with increasing stock movements, at least this is our opinion, as the economy continues to improve. So that's kind of our base case scenario here. Now there's a lot that's going on. You know, there's all sorts of stuff going on internationally right now that is having headline risk with the stock market, with the bond market. So there's going to be noise in between, but we believe that the overall picture is that the economy is improving, which will tend to, in our opinion, lead rates higher and lead stocks higher. International, we've got the same chart here. You can see 2000, 2007, 2014. We've got a similar picture to what was going on with the S&P 500. A little bit lower valuation versus the S&P 500 has a higher valuation now than it did in 2007. But you look at the price earnings, or I'm sorry, you look at the overall EFA index, and we're still way off the levels of where we were back in 2007. And you say, well, how can that be if, you know, we're recovering and things are going well? Well, Europe and some of these international countries, they took a little bit different approach to monetary policy and fiscal policy, mostly fiscal policy, and it's had a detrimental impact on their short-run performance relative to the United States. So you can see back in 2012, the Eurozone was very negative because they went through a period of austerity. And it's only now that we're starting to see those countries start to improve, whereas the United States, Canada, the UK has been improving since, you know, late 2012, early 2013. You can see emerging markets are starting to get better a little bit. So if you look at overall right now, the global economy looks fairly well positioned. But if you look at Europe, they definitely went a different way with austerity, and that's partly why you see no new high in the EFA index as of yet. So the Eurozone, like I said, they took their medicine early. If we look at the Eurozone, they had government fiscal drag between 2010 and 2013 of about negative 3.4% per year. Going forward, though, they're going to have much less of a fiscal drag because they've already taken a lot of their medicine. So that's going to drop to 0.7%. That's one of the reasons that we actually do like international. We believe that there's going to be some positive price movements from some of the stock indices in the international space because of some of these topics that we're going over right now, like the fiscal drag reduction. Valuations on a wholesale basis, developed markets, if we were to look in historical perspective, valuations are getting a little bit more expensive for developed markets. But in the context of low interest rates, you could definitely make an argument that PE multiples, valuation metrics should be higher during this period than versus a period where the 10-year Treasury is at 4.5% versus 2.5%. So you definitely can make that case. And we believe that if we look at developed markets as a whole, we're more in line with properly valued, with the emphasis on growing revenues to increase stock prices versus what we've seen over the last 5 years, which was increasing multiples to increase stock prices. So we believe that we're getting much more closer to fairly valued if we're not there already. And what's going to move the market is not people getting more confident and PE multiples expanding, but actually companies earning more and making more revenue. The emerging markets is a little bit different story. We're very positive on emerging markets. We think they're still undervalued. In this interest rate environment, we could argue they're very undervalued. We've had an overweight to emerging markets for quite a while. It's paid off so far this year. Emerging markets are outperforming domestic markets by roughly 3% when it comes to stock price movements and total return from the indexes. So it's been good to be overweight in emerging markets in 2014. In 2013, it was horrible to be overweight in emerging markets. We believe that there's a real opportunity there when we look at PE multiples, when we look at PB multiples, price to cash flow. When we look at all these valuation metrics, we believe that there's some real opportunity in emerging markets, and that's why we continue to be very bullish when it comes to emerging markets. The second quarter earnings, there's about 75% of companies that have reported, and so far we've got about a 5% growth in revenues and about a 10% growth in earnings. The earnings per share number that we're looking at is over $29 a share. So that'll be a record quarterly operating earnings number for the S&P 500. And if we look at how companies are doing this, they're starting to increase revenue. So it's not all multiples and it's not all price cutting. They're actually starting to increase revenue, which is a very positive sign. And they've done it with much less leverage than they have in the past. So they're doing it in a much more prudent way. They're not leveraging up to increase these revenues. So there's a lot of room to run. You can make an argument that with, if they added a little bit of leverage, if they had the opportunity to do so, and the demand was there, they could increase leverage a little bit and help that top line and help that bottom line and continue to drive the earnings per share number even higher. One economist that I listen to and respect made a case for about $135 a share earnings for the S&P 500 with a 20 multiple. That puts us at an S&P 500 of 2,700 in the next 5 years. Not to say that that's going to happen, but he made a pretty good argument for that being the case over the next 5 years. So we're very cautious with bonds. We're very optimistic with stocks, and we believe that there is some potential for some upside still in stocks, even with the great run we've had over the last 5 years. Yield alternative, domestic and global. You know, when fixed income, it doesn't look great. We've got to go elsewhere for some yield. So utilities is a good space for that. We've got some good yielding companies in our utilities portfolio, and you can see some of the equity dividend yields here versus the 10-year government bond yield, internationally especially. And then we've got the REIT yields, and internationally very much has a huge benefit for having some of these international REITs inside of our portfolio as well. And then we also look at total return, and you know, over 1926 to 2013, if we look at the S&P 500 total return, we want to focus on dividends, because they're about a third, a little over a third, maybe 40% of our total return comes from dividends. The other 60% of those returns comes from capital appreciation. So we want to make sure that we're looking at both of those. REITs and utilities and some other higher dividend-paying companies definitely are infused inside the portfolio so that we're getting a little bit better dividend yield. In fact, emerging markets and international also have very good dividend yields, and that's been helping our cash flow inside of the portfolio, which helps us purchase things that aren't maybe doing as well intra-quarter. Cash accounts, cash is still paying us next to nothing in 2013. A couple of 6-month CDs would have paid you $390 for the year. Not a great investment. Money supply as a percentage of nominal GDP. You can see we're still sitting at very high levels of cash on the sidelines. So there's still room to run, in our opinion, with folks still not believing that this is a true bull market yet. Mutual fund flows. The table on the top shows mutual fund flows over time. The bottom left chart shows flows into ETFs and mutual funds. And the bottom right chart shows the difference between flows into bond mutual funds and flows into stock mutual funds. This page right here makes it very clear that investors have embraced bonds since the financial crisis. Until recently, equity flows have outpaced bonds over the last 12 months or so, with the exception of the first few months of this year. At the beginning of this year, the S&P lost about 6%, and that has a lot to do with why some of these bond flows may have outpaced equity flows early this year. But we believe that the overall trend is going to continue, where we see bond flows, bond outflows, and equity inflows. Hence why our portfolio is positioned the way it is, and our base case scenario where the economy improves, bonds do poorly because interest rates increase, and stocks do okay because companies are able to increase revenues and earnings and increase stock prices. Stock valuations. I really like this chart for this bottom right graph here, which is the S&P earnings yield versus the Moody's BAA yield. And you can see that in 2000, this earnings yield got let down to about 4%, whereas our bonds were giving us over 8%. It's easy in hindsight to look at that and say, well, man, I should have been investing in bonds yielding 8% when my earnings yield on the S&P 500 was only 4. But it's hard to actually do that when the S&P 500 year after year is earning 3% or 30% for 3 years in a row. That starts to get people to flood into the S&P 500 or into equities because they're greedy. They get greedy and they want to make 30%, not 8%. But in hindsight, when you look at this big gap, it's pretty obvious. Okay, I should have been buying bonds then, not the S&P. Okay, in late 2011 and in 2010, and well, not so much in 2008 because bond yields also spiked. But we've got a huge gap here, and it would have been, in hindsight, it would have been a great thing to buy the S&P 500 and not as much with bonds. But there's still this gap here. So until that gap starts to go the opposite way, we're still favoring equities versus fixed income. PE multiples and equity returns. Had this one in here quite often. Over 1 year, you never know what's going to happen with the market. That's true not just with PE multiples, but if you look at any metric on a 1 year basis, doesn't matter stocks, bonds, it's very difficult to predict, if not impossible to predict where bonds are going to be in a year, where stocks are going to be in a year, what the returns are going to be. If you increase that time horizon to 5 to 10 to 20 years, we have a much better idea of what's going to happen with asset classes than we do over a 1 year period. So this chart right here just shows PE multiples and total return over 1 year periods of time. You can see there's not really a correlation here. It doesn't really matter where your PE multiple is. It doesn't really tell you. These dots are all over the place. I can't tell you with any confidence whatsoever what the 1 year return is going to be based on a PE multiple. But if we look at PE multiples and we look at the next 5 years annualized periods, now we start to get a lot better relationship here. And you tell me that the PE multiple is 15, 16, I can tell you a little bit better idea on what to expect from our equity performance over periods of time like that. So it gives us just a little bit better idea. And right now, we're at about 15.5 for a PE multiple, which in history has been about fairly valued. If we continue to have revenue and earnings growth, that should equate to higher equity values. Diversification and the average investor. More diversified portfolio is going to can reduce our risk significantly without really giving up the return. This is just a hypothetical portfolio versus one with a lot of asset classes, one with not as many asset classes. The returns are very similar, yet the risk is significantly less with the more diversified portfolio versus the less diversified portfolio. The average investor, a study done by Dalvar, just shows that the average investor has earned about 2.5% over the last 20 years versus some of these other indexes where if we would have just bought and held and not worried about the fluctuations, we would have gotten a much higher rate of return. The average investor is basically keeping up with inflation. A lot of that has to do with emotions and buying and selling at the inopportune times versus having a more long-term approach to your investment philosophy. Once again, this just shows the importance of having the right time horizon. Like I said before, you give me a 1 year period of time, I can't tell you where equities are going to be. I can't tell you where bonds are going to be. There's such a big spread. The best year from 1950 to 2013, the best year for the S&P 500 was 51%. The worst year was negative 37%, and everywhere in between. So equities cannot be an investment for a 1-year time horizon. Your distribution of outcomes is just enormous. Even bonds. You look at bonds, and the best year is 43, the worst year is -8 over this time horizon. That's still a very, very large distribution there. And if we had a 50-50 portfolio, still a very large distribution. Now, if we look at 5-year periods of time, now we can start looking at, okay, a 50-50 portfolio over this period of time would have not lost money on any 5-year period of time. The worst 5-year rolling total returns would have been 1% per year. Nothing to write home to mom about, but you didn't lose money. So we really want to make sure that if we're in stocks and bonds, we want to have the right time horizon. Usually that means 5+ years. If we're looking at stocks, that probably means 10+ years. And the further we go out, the better, the lower the distribution and the better our results become for holding more aggressive assets. You see over this period of time, the average total return for stocks has been 11.1%. If we would have had $100,000 over 20 years, growing at 11.1%, that equates to an $827,000 portfolio in 20 years. Bonds earned 6.1% over that period of time. 100,000 grows to 327, and if we had a 50-50 portfolio, you're at 9%, which over 20 years equates to a $564,000 portfolio. So just time, the importance of the time frame is why I bring this slide up every single presentation. I think it's very important for everyone to remember this key investment philosophy. This slide I wanted to end with, I think it's the last slide. If not, it's one of the last slides. Just to remind everybody that volatility is par for the course. We have not seen volatility over the last 2 years. The biggest intra-year pullback we've seen is 6% through the last 2 years. So, and then even if we include 2013, the most was 10%. I mean, give me a break. We expect intra-year drops of 14.4%. That's the average intra-year drop, even though annual returns are positive 26 out of 34 years. So the fact that we haven't had even an average drop in the last 3 years should tell you that we have not seen volatility. Volatility has not been prevalent in this market. That is unusual. Usual is volatility. And so when we have a couple of day period of time where the stock market goes down 3%, that's not out of the ordinary. The reason that over long periods of time we get paid a little bit more to hang out in stocks than we do in bonds, and more in bonds than we do in cash, and vice versa, is we're putting ourselves at the risk of having an intra-year drop of 28% or 34% in 2002. And over the long run, we can start to expect these higher rates of return, but we're going to put ourselves at risk. And that's why we build these diversified portfolios, because every one of our investors has a different goal, and some can and can't take a 28% or a 49% intra-year drop in part of their portfolio. So we want to make sure that we have the correct portfolio for each and every one of our clients. So that was the last chart there. What does this all mean to the portfolios? Investment implications. This has changed a little bit. We made some pretty big changes in the portfolio recently. Our overweights are commodities. Our overweights are short-term treasuries, or what I would refer to as a cash alternative, kind of hanging out until interest rates improve or credit spreads improve so that we can get paid for the risk that we're taking. We're not getting paid a lot in these short-term treasuries either. It's just a safe haven for our bond portfolio until rates, in our opinion, stabilize and the Fed kind of gets out of the way. There's a lot of unknowns with when the Fed unwinds that balance sheet. That's going to start to happen, and we don't know how the bond market's going to react. We'd rather be safer in our bond portfolio and be protected, and so that's why we've opted for a bigger position in these short-term treasuries. Market neutral is another safer, another lower volatility area that will give us an okay return, but more importantly, lower volatility without taking maybe necessarily interest rate risk. So it could be an alternative for some of our fixed income in some of this market neutral area. Emerging market equities, I already talked about those. We believe they're undervalued. We believe that they've been out of favor for the last 3 years, and that's starting to turn around. So we like that space. We're underweight fixed income long duration. We're underweight credit-sensitive bonds, and we're underweight domestic equities. We prefer international. So that's kind of the investment implications. We are constantly changing the portfolio, and for most of you, our relationship is on a discretionary basis, so we've been making these changes for you. With that, we'll leave it with questions.
Okay, you heard it directly from Sean. We are opening up the floor for any questions from the meeting attendees. Please feel free to type your questions into the chat box that is attached to your GoToWebinar toolbar. Okay, the first question. To what degree will the reduction or elimination of quantitative easing have on inflation and market values?
So we hit this one pretty hard during the presentation. I think this question was actually asked during the presentation or before the presentation. What the Fed has done is really unprecedented. So it's very difficult to know exactly what's going to happen. I think that the things we want to focus on, we have a massive liquidity out there. And what we need to do is we need to focus on how banks are using that liquidity and the velocity of money. That's going to dictate, in my opinion, how inflation is going to be impacted. I'm trying to get back to that Fed slide here. Yeah. So we have massive liquidity here. But until banks start lending that money out, economic activity they're really pushing on a string. It's that analogy of taking money out of the top drawer of the desk, putting it in the bottom drawer of the desk, and shutting the drawers. They haven't done anything until that velocity picks up. They're just flooding the system with liquidity. Banks are just saying, we don't want the liquidity. We want to keep it as excess reserves, and that's why you haven't really seen any increase in inflation, but a lot of people are worried about it because there's this huge balance sheet that the Fed's got. So we've got to keep an eye on it because it could go fast. And the other thing that the other part of the question was market values. It really depends on how quickly they sop up that liquidity and increase interest rates, and how the real estate market reacts to it, and how companies react to it, and how people react to it. That's the bigger hurdle with the Fed. It's not necessarily that their liquidity and their purchases are doing anything economically right now, but psychologically it's doing a lot. and you've got large institutional investors and day traders and options guys and all these folks making bets. You know, that's not what you're going to hear from Ironwood. We're not making bets with the portfolios, but there's a lot of institutional and professional investors out there that are making bets that, hey, the Fed has been acting as a backstop, so we're going to take this opportunity to buy aggressive assets because we think they're going to go out. If the sentiment changes and folks start to think the Fed's going to do more stopping up than what the markets think, and that backstop may not be there, then asset prices could do what we saw them do last summer, which is stocks, you know, dip pretty good, but bonds actually dipped even worse because interest rates spiked up, which impacted stocks. But the overall economic data that we see is very positive. So we believe that the Fed is going to be able to exit, and it's definitely going to be choppy, or at least we think it's going to be choppy. And we should expect a lot more volatility than what we've seen over the last 2 years. But in the long run, we believe that positive economic data is positive for stocks and negative for bonds. With that said, we will never, you know, go outside of our clients' comfort zones. We build portfolios for particular goals, so we're never going to abandon an asset class like fixed income just because we don't believe that it's a great opportunity. We need the safety of fixed income, and that's why we've opted for those short-term treasuries for now while we wait to see what the Fed's going to do.
Okay, our next question here is, in emerging markets, what countries do you favor, or what countries do you stay away from?
That's a tough one in the emerging markets, and that's why in part of our portfolio we have experts that are looking out and managing those portfolios for us, and then in some areas we just buy the index. But you can see here from this valuation metrics, I would favor the BRIC countries more, and when I say BRIC, I mean Brazil, Russia, India, and China. India's over here. So all of those, you can see undervalued, 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 undervalued. Now there's reasons that these are undervalued, and you need specialists in there to pick the companies that are in each of those countries. But those are the areas that have been hit the hardest, especially China. We are very bullish on China. Brazil, they're not as undervalued, and India is not as undervalued. India has actually had a really good run as of late. But those are some of the areas that we would favor as far as country specific.
Okay. And then last question is, given the potential for rising interest rates here over the course of the next year and a half, what would be your outlook seen for the utility and REIT asset classes?
Well, REITs and utilities are very favorable when interest rates are not changing. They act very similarly to fixed income. Right now, they're giving us a yield advantage, but as interest rates increase, they're going to get hit. And we saw that last summer. As interest rates increased, utilities and REITs did very poorly. So depending on how fast that happens, it could really hinder those asset classes as well. If it's a slow rise in interest rates, it might not be as painful in some of those areas, but increased interest rates would have a negative impact on utilities and REITs in general.
Well, that concludes our presentation for tonight. feel free to type any last-minute questions into the box if you have any final thoughts. But I think with all that said, we'd like to go ahead and wrap up and thank everyone for attending this evening. We certainly look forward to inviting you back for our fourth quarter Market Insight webinar, which will be tentatively scheduled for November, early mid-November timeframe. So stay tuned for that email invitation. And Steve, did you have any final comments? I just wanted
to let everyone know we appreciate everybody tuning into the call. If you guys have any questions, please don't hesitate to reach out to any one of the Ironwood representatives and or team members. So with that, we'll go ahead and conclude tonight's presentation. Thank you for thank you for tuning in, and we'll see you guys next time. Take care.